You guys heard in the video that there's two primary different types of life insurance. You have whole life and you have term life. Whole life is really designed for one thing and one thing only, and that's your final expenses. Because whether you're 22 or 92, somebody has to pay to bury you, okay? You use whole life for this because whole life pays out 100% of the time. It pays out when you die, okay? Whole life builds cash value, and it also builds paid up value. If you kind of imagine a bucket here, every month you make your premium payment, it goes into this bucket. And the bucket starts to fill with the cash premiums that you've been making. Let's say you pay on this for 30 or 40 years. You've built a cash value to this. You can borrow from that cash. You can take a loan out from that cash. You can cash the policy out and take all of your money back if you want to, or take whatever cash value that's in the policy back if you want to. That's called your cash value. You can also take what's called a paid up value. Here's the purchase price face value, is this top of the bucket, okay? Let's say you've paid this much cash into it, and that much cash has paid off this much of the policy. You can say, you know what, I don't want to pay on the policy anymore. I want to take my paid up amount. You stop paying on it, and you've got this much life insurance for the rest of your life that you never need to pay another dime on. It's kind of like buying your house. Every month you make a payment on your house, you own a couple more bricks of your house, right? Same way whole life works. Every month you make a payment on it, you own a couple more bricks of your policy. Make sense? Okay. Now term life. Term life is temporary insurance, and everything you get through employers is always term. Okay, your insurance you get through employers is term. Term life pays out 1% of the time. It pays out if you die. What do you mean if I die? Well, when you work for an employer, you have that coverage. If you've worked there for 10 years and you quit that job and you don't die, does that coverage go with you? No, you've just lost that coverage, so it never paid out. It only pays out if you die during the term of the policy. That's what makes term so cheap. An insurance company knows if I have a $100,000 10-year term out here, if I have 100 people who have this policy in the next 10 years, they're only going to have to pay out one policy. Only one of those 100 are going to die. So they can take this 100,000, divide it by the 100 people, divide it by the 10 years. Much cheaper policy, right? Okay. The only family that financially benefits from this policy is the family of this poor guy right here who died. Okay. The other 99 do not financially benefit from the term policy, but do they benefit from that term policy? Yes. They have peace of mind knowing that if my primary breadwinner does die, that my family's taken care of. Now you use term, temporary insurance, to protect temporary expenses. What are our temporary expenses in our life? Our income. We need to protect our income. If we die, we want our family to stay at the same lifestyle, okay? But we only need to protect this during our working years. Once we retire, we no longer need to protect this, okay? We need to protect our mortgage. We want to make sure our house is protected, where if I die, my family doesn't lose my home. But again, you only need this while you own your house. Once your house is paid off, you don't need that anymore. And the third thing is your kids' college education. You want to protect that to where your kids could afford to go to college if they want to. And if you're not here, it can still be provided. But once they're grown, you no longer need that. So this is also an additional temporary expense. Make sense? Okay. Term works like your car insurance. Here's that same bucket. When you pay into the bucket, what happens to the money? It goes right out the bottom of the bucket. You can pay on your car insurance for the rest of your life. Never have an accident your entire life. Can you go to your car insurance agent and ask for all your money back? No. Why? Because you're renting your insurance. It's only good while you pay on it. That's the same way term works. It's like renting your house. You can rent a house for 30 years. At the end of that 30-year period, how much of the house do you own? None. Same way term. So here you are. Let's say for example purpose, you're 30 years old. Let's say at the age of 30, you pick up a $100,000 whole life policy. Whatever it is, whatever cost it is at the age of 30, it's the same cost at the age of 40. It's the same cost at the age of 50, same cost at the age of 60, same cost at the age of 70, 80, and the average lifespan today is 85 years old. So the whole life policy will never go up in price, never go down in price, You can never lose it once you've got it, as long as you make all your payments. But whole life comes with a couple different options. What do we all want to do at the age of 65? Retire, right? Okay. Well, when you retire, what happens to your income? It goes down. Okay. Well, a lot of times if our income goes down, we want our expenses to go down as well, right? Okay. So whole life comes with a couple different options. Number one, you can keep paying on it for the rest of your life, and it'll never go up, never go down in price, and it's just fixed. Or you can say, you know what? By the time I'm 65, and this is just example purposes, let's say into my $100,000 whole life policy, by the time I'm 65, I've paid $30,000 into it. But my cash value at that point is $40,000. At 65, I can say, you know what? I don't want to have my life insurance anymore. I'm good to go. I don't need life insurance. I'm going to argue with you about that because I disagree with you. But that's what you feel. You cash your policy out. We'll give you $40,000. And this is just an example. These are not real numbers, okay? Or you want to say your cash value, you take your paid up value, which means maybe you've paid $30,000 into it, but out of the $100,000, $70,000 of it is paid off. You can
just reach maximum recording.
You did?
Yeah, I reached like 3 minutes.
Oh, you did? Okay.
Yeah.
So $70,000 is paid off. So you can stop paying on it, and you've got $70,000 worth of life insurance for the rest of your life that you never need to pay another dime on. Okay? That's how whole life works. Now, term, that same $100,000 term policy when you're 30 years old is way down here, much cheaper. But then it's a 10-year term. What happens in 10 years? It goes up in price. So it's fixed there for another 10 years, and then it goes up in price again. It's fixed there for another 10 years. It goes up in price again when you turn 60. Fixed there. Every 10 years, that policy is going to go up in price, and every 10 years, you have to requalify for it, and it's going to go up in price. And then when term hits the magical age of 65, term is going to do one of two things. It's going to become so costly you can't afford it anymore, or it's going to go away. But it's going to definitely do one of those things. Either way, it goes away around the age of 65. In a normal life, we grow up, get married, have some kids, buy a house, we hit our peak earning period. Kids grow up, house gets paid off, we retire. This is our need for term going up. This is our need for term going down. The only constant we have in our life is our need for whole life. This is when you need to have them combined. Okay? What most people, where they make the mistake, is they have term all of these years. When their term goes away, they realize they're uninsured, and they try to pick up a whole life policy right here because it's the only thing you can get. Unfortunately, at that point, one of two things typically happens. It's typically too expensive to where they can't afford it anymore, or they don't medically qualify for it. Okay? So, does this make more sense? Do you understand now the difference between whole life and term, and how it works in your life, why you should have a combination of it during this year, so that at this point you've already got this in place? Does that make sense to you? Great. Okay. Now, go ahead and shut it off. Okay.